How do people participate in the Forex market? So far, you've learned what Forex is, how big it is, and that currencies trade in pairs. Now, how do you trade it? Traders use several financial instruments: retail Forex, spot FX, currency futures, currency options, currency ETFs, Forex CFDs, and spread betting. We'll focus on how retail traders can get involved, not institutional swaps and forwards. Let's explore each method in turn: what it is, where it trades, and its pros and cons. We'll start with currency futures, contracts that fix a price for a future date. This is for beginners. Clear definitions and practical differences, so you know where retail traders operate. Stick with me. By the end, you'll know the main ways to trade Forex, and which are most relevant to you. First up, currency futures. Exchange-traded, standardized contracts with visible prices and regulation. Currency futures were popularized by exchanges like the Chicago Mercantile Exchange, offering transparency and regulation. A futures contract specifies a currency, a price, and a set date for delivery. Pros: centralized market, transparent pricing, and good liquidity for major contracts. Cons: contract sizes and exchange hours may not suit all retail traders. Options give the right, but not the obligation, to buy or sell a currency at a set price on or before expiry. Buyers pay a premium for optionality. Sellers take on obligation if assigned. Options trade on exchanges like CME, ISE, and PHLX. But liquidity can be thinner than futures or spot. That means wider spreads and sometimes limited hours for certain currency options. Currency ETFs let you gain exposure via a managed fund. Buy shares like you would a stock. ETFs can represent a single currency or a basket, useful for speculation, diversification, or hedging. But ETFs trade on exchanges with commissions, and they don't trade 24/7 like spot FX. So timing and transaction costs matter. Next, spot FX, the primary over-the-counter market that runs nearly 24 hours a day. Spot FX is an OTC market where institutions trade directly with counterparties, the interdealer or interbank market. Trades happen electronically or by phone. There is no centralized exchange. A spot FX transaction is an agreement to exchange one currency for another at the current spot rate. Although called spot, settlement commonly occurs 2 business days later, known as T+2. For example, a trade on Monday settles on Wednesday. Some pairs settle T+1, like USD CAD, USD TRY, USD RUB, and USD PHP. Unlike futures or ETFs, spot FX are bilateral OTC contracts, not exchange-traded standardized contracts. The interdealer market is mainly for institutions that trade very large volumes. Retail traders don't access that primary market directly. They use intermediaries. A spot trade is technically a binding agreement to deliver currency, but most Forex participants never take physical delivery. Instead, contracts are rolled or closed before settlement. So how do retail traders participate? Through Forex trading providers, commonly called brokers. Providers access the primary market on your behalf, add a markup, and show you prices on their platform. Important: many retail providers act as your counterparty. If you buy, they sell. If you sell, they buy. Retail spot FX is usually a rolling contract, not intended for delivery, and often offered with leverage. Leverage lets you control large positions with small capital. Example: 50. One leverage means $2,000 can control $100,000. That amplifies both profits and losses. You cannot settle the full currency amount, so positions are rolled or closed. Retail trades are closed by offsetting with an opposite transaction on the provider platform. To avoid physical settlement, brokers roll positions via Tom Next, tomorrow, next day. Rolling produces swap or rollover fees. You might pay or earn interest depending on the currencies. Regulatory treatment differs. In the EU, UK, rolling spot contracts are treated like CFDs. In the US, CFDs are restricted and retail Forex is called a retail Forex transaction. Spread betting is common in the UK, but illegal in the US. Always check local rules. Recap: futures and options trade on exchanges. ETFs trade like stocks, while spot FX is OTC and powers most currency pricing. Next, we'll look at retail products you'll commonly see: CFDs, spread bets, and how brokers facilitate access. Let's dig in. Retail Forex is typically accessed via CFDs or spread bets outside the US and rolling spot contracts within the US regulatory framework. A CFD is a derivative contract that tracks the underlying asset price. You never own the currency. With a CFD, you can go long or short. Profit or loss equals the difference between open and close prices. If price moves in your favor, you profit. Against, you lose. Simple in concept, risky in leverage. Spread betting offers similar exposure but pays out per point of movement. It's common in the UK and often tax-advantaged there. Remember, spread betting is illegal for retail traders in the United States. CFD and retail providers derive prices from the spot market or internal pricing. Check that the provider's prices mirror market prices. Leverage enables large exposure with small margin but introduces margin call risk if the position moves against you. Always know your margin ratio and stop-loss settings. When positions carry overnight, brokers roll them via Tom Next and apply swap charges. Depending on interest rate differentials, you may earn or pay swap fees. Practical flow. Open an account, fund it, place a trade, monitor, then close or roll the trade. Retail providers make money via spreads, commissions, and overnight fees. Compare costs across brokers. Lower spreads lower trading cost, but also check execution quality and counterparty risk. Retail Forex trading is speculative. Traders bet on exchange rate moves rather than owning currencies. Only risk capital you can afford to lose and use risk management tools like stop losses. Regulations differ. CFDs and spread bets are common outside the US. US retail Forex has distinct rules and restrictions. Tax treatment, legal availability, and leverage limits vary by jurisdiction. Beginner checklist. Understand the instrument, check fees and pricing, know leverage and risks, and practice on a demo account. In practice, futures suit some traders, options others, ETFs for investors, and CFDs are spot for many retail traders seeking flexibility. To recap, participation can be exchange-based, futures, options, ETFs, or OTC, spot FX. Retail traders typically use brokers offering CFDs or rolling spot contracts, sometimes spread bets where legal. If you're starting out, open a demo account, compare providers, and study margin and rollover rules before trading live. Thanks for watching. Subscribe for more Forex basics and check the description for links and resources.